Okay. So climate scenario analysis is a widely used and recommended tool for all parts of the economy to consider the potential impacts of climate change on their business and their investments. And for the pension sector, climate scenario analysis is an essential tool in shaping asset allocation and investment strategy. We all know that systemic risks like climate change and biodiversity loss is already having significant financial impact across investments, which essentially will challenge the fiduciary duty of a pension to its pensions members. But are the climate scenario models that are used today by the pension sector really giving us a clear understanding of the impact of these systemic risks and how they interact with both macro and financial variables, both in the short and in the long term? Now, scenario analysis is not a simple process, and this is a complicated and nuanced challenge. However, it is absolutely critical part of the solution. We only have 5 years left to halve emissions by 2030 and keep below 1.5 degrees Celsius. And to bring this closer to home, the EU's Commission's focus on transforming the EU into a clean, resource-efficient and competitive economy is starting from the knowledge that the EU is not fully on track to meet its 2030 target of reducing emissions by at least 55% below 1990 levels. We are currently on a path towards 2.7 degrees Celsius, and current extreme weather events are demonstrating right now what we will face in the near-term future, let alone the long-term future. And scenarios should be able to support both mitigation and adaptation strategies. This session, and I'll stop with the doom now, but this session will look at what this all means and what practical steps you can take back into your organisation. So I am delighted to be joined by a brilliant panel. We have Mark Cliff, who's the visiting fellow at the Global Systems Institute at the University of Exeter, and Mirko Cardinal, Head of Investment Strategy at USS Investment Management. And they are both the author of the new scenarios that USS are now using, and Mirko will be talking about later. We've got Wilhelmina Verdigau, co-founder and chief product officer at Trex. And last but certainly not least, Simon Perham, head of investor outreach at Carbon Tracker. Before we go into the keynote by Mark Cliff, we're going to just start with a couple of very quick poll questions. So Olivia, if you could start with the first one, thank you. Does scenario analysis inform your investment decision-making processes? Could you please answer that one to start with? We've only got 3 to go through. So the answers are no, we don't currently run scenario analysis. No, we do scenario analysis, but it doesn't affect our decisions. It doesn't impact on our decisions. Yes, but has not meant big changes in our investments. Yes, it has resulted in big changes in our investment decisions. Okay, and could we have the results, Olivia? Brilliant. Okay, so this is a really interesting results. So I think scenario analysis obviously is not something new, but we are hearing about the challenges with then embedding that into the investment decisions. So that's really interesting to explore later. The next question, please. How do you use climate scenarios, for those that do, to comply with TCFD reporting requirements on climate resilience, to support stress testing and risk management processes, to support net zero transition target setting and planning, to support your investment allocation decisions? And you can pick all that apply here. Hey, Olivia?
Hello.
There we go. So a real mixed bag on that. And I'm assuming that most people ticked more than one on that. Okay, and the next question, last question. Do you see the relationship between the pursuit of sustainability goals and business performance as a win-win, where environmental commitments directly enhance financial value, a trade-off where they harm financial performance with uncertain long-term benefits? And what have we got as the results, Olivia? Okay, interesting. 2/3 of saying a win-win and a third, more than a third, saying a trade-off. And again, I think this is something that will evolve over time when we have more data to back up where those investments are being made. Okay, with no further ado, and bearing in mind we have a packed agenda for today, I'm going to hand over to Mark for his keynote. So thank you, Mark.
Thanks very much, Kerry. I wonder if I could share my slides. That's possible. Olivia, have you got the slides, or can I get control of the screen?
You should be able to get control of the screen, otherwise I can share them.
Okay. I'm getting a message saying disable participant screen sharing, so I can't at the moment.
I'll just start to share them.
Okay, thank you very much. I'm delighted to be participating in this, given the caliber of the audience, and I think judging by the poll responses, you're all very much engaged in this field, and I'm going to give you essentially a sort of two-part presentation. One, to analyze why we have a problem with the conventional scenarios which have been adopted by the financial services industry worldwide. And the other part will be talking about how we can go about addressing the problems that have been raised and move towards what I call decision useful climate scenarios. So if we go on to the next slides, please. So the key point essentially is that the long-term scenarios that have been produced by the Network for the Greening of the Financial System, the NGFS, which is the global group of central banks and regulators, are really not fit for purpose. They're based on smooth global warming pathways, which systematically understate the risks and opportunities that we face from climate change. And frankly, they're of little use for the urgent needs for bespoke transition plans and risk management. I was very interested in the poll response, which showed that the biggest single use case that the participants had for climate scenarios is actually risk management and stress testing, not transition planning. That's a very important distinction that I'll come back to later on. The key point here is that what we need to do is to have a paradigm shift towards decision useful scenarios that are focused on rather shorter term narratives, by which I mean 5 or at most 10 years ahead rather than 25 plus, which embrace the acronym VUCA: volatility, uncertainty, complexity, and ambiguity, and financial materiality, because financial materiality is what you're all obligated to deliver. This is a fiduciary duty, whereas impact goals such as net zero, for the moment, are still voluntary. In the EU, reporting of such commitments is becoming mandatory, but to actually adopt such goals and indeed to deliver them is not yet mandatory. So financial materiality is really the critical thing that needs to be delivered by the scenarios, and this is something which is not really delivered by the NGFS style scenarios. And the elephant in the room is double materiality here. So in other words, this question of reconciling financial materiality and impact materiality has to be confronted head on. I was very interested to see that a majority of you believe that adopting impact goals is a win-win in terms of profitability. I'll say up front, I disagree with that view, and I will come back to that later on. So, next slide, please. So the first thing to recognize is that scenarios are not forecasts. We are dealing here with a situation of radical uncertainty, which is in many respects unquantifiable, and it's beyond the reach of conventional models. So the whole point of having scenarios, and I emphasize the plural here, is to address these radical uncertainties head on. And I think, one particular aspect which should be obvious, which is not actually embraced by the official scenarios, is that geopolitics and politics are a critical driver of most climate scenarios. After all, that is what dictates a lot of the pace of transition in the global economy. This is something which is not evident in the official scenarios. I would also emphasize the point that unless you've actually got the right narratives, you are not going to save yourself by any amount of modeling. You have to be asking the right questions. What is the purpose of the scenarios? I'll come back to that in a moment. So next slide, please. Now, interestingly, the NGFS throughout has conceded that there are limitations to its modeling approach. Despite that fact, it persists with this even in its phase 5 scenarios, which were released a few weeks ago. They're not fit for purpose because they essentially ignore many of the risks that we face. They're fundamentally unsuited for the needs of business. And you can see the quote on the bottom right here. And this is the critique that they themselves put forward last year. By emphasizing low frequency long-term dynamics, these scenarios only provide a limited picture of the possible transition and acute physical risks in the near term. They're unfolding at high frequency, and their interaction with the business cycle shocks that are important. So, they know they have a problem, but so far they haven't addressed it. Next slide, please. So the essential point here is that we are not dealing with normally distributed risks. Most of you will be familiar with the normal distribution, which is this black curve here. This is the probability distribution in statistics, which is normally distributed, symmetrical, whereas when it comes to climate risks, they are fat-tailed. There are risks skewed towards the downside, and the probability distributions themselves are non-stationary. In other words, the situation is getting worse because we are probably going to see some fairly major tipping points in the climate. And my colleagues at Exeter, led by Tim Lenton, have written extensively about the dangers of these tipping points. The good news is, on the other hand, is that technological progress is positively skewed. So there is hope for us to address the increasing physical climate problems that we have. But structurally, the models that are being used by the NGFS understate the risks and indeed the opportunities. So next slide, please. So this is in many ways the key slide. I don't have time to go through this in great detail, and incidentally, you will be getting a copy of these slides, and feel free to contact me if you want to talk about it further. But there's essentially 6 steps in the modeling chain for these long-term scenarios by the NGFS. You've probably heard about the concerns about the modest GDP damages that arise from the climate modeling, but there are 3 steps ahead of that which are also understating the risks. The first point, and perhaps blindingly obvious one, is that they've made the assumption of only one pathway for economic activity. The global economy basically doubles in size by 2050. This is using the IPCC's Socioeconomic Pathway 2, SSP2. They've ignored the other 4, which vary by, give or take, plus or minus 30%. So that's already stripped out a lot of potential risk and volatility. There's essentially implicitly the same pathway for politics and the same pathway for behavior, for demographics and what have you. So they take that one pathway for GDP, they plug that into energy models to generate an emissions profile, which is modified by climate policy, which is proxied by one single variable typically, which is a global carbon price. So you can see this is a huge simplifying assumption. And despite that, the different integrated assessment models that they use produce wildly different results. Then this is put into climate models to show what the impact of that is on physical risks, but they've only really been modeling a limited selection of those. So things like sea levels don't enter into this. Quite a few of the extreme weather risks have only recently been incorporated. And they're certainly not looking at tipping points or the extremes of the distributions. So all of those things help to explain why you end up in a situation where the estimated damage to GDP is actually relatively modest. They have actually changed the damage functions in the latest phase. In fact, they increased them between 3 and 5 times. Just think about that, that's a huge increase. And yet they still admit to some limitations. So, this gives you an indication of the degree to which they're understating the risk. Then they go from these GDP losses to an estimate of what this does at the sector and the asset level. And then they finally get to finance. They start to bring in the financial consequences at the very end. They estimate impacts on valuations through net present value calculations, but of course this understates market price volatility. Market prices are far more volatile, in fact, probably 4 or 5 times more volatile than underlying fundamental valuation. So I think, that gives you an idea of the problems that there are with this modeling process. Okay, so next slide, please. And it's hardly surprising, therefore, that if you plug all this in and you stripped out a lot of the risks, you end up with very trivial impacts on investment returns, even by 2050. This table is taken from a University of Exeter IFOA publication from last year called The Emperor's New Climate Scenarios, which showed some of the losses in terms of investment returns that different institutions are reporting, roughly 3.5% over that 20-odd year period. This really doesn't make sense in relation to what I've described, and certainly nowhere near the kind of damages that the climate science is pointing to. So that's the problem. Okay, next slide, please. And underpinning all of this is essentially a culture of scientific conservatism, which is that if they don't have the evidence for things, they tend not to talk about them. They're waiting forever for more data and more models. But this is, of course, completely contrary to the culture of risk management in the financial services industry, where you're paid to worry about the things that you can't quantify as well. You have to deal with the uncertainty, particularly if it's skewed to the downside, as I've described. And unfortunately, although the science is very good about noting the caveats and the limitations of their work, these tend to be rather ignored by practitioners. So this is essentially a cultural problem that needs to be addressed. Next slide, please. Okay, so what's the way forward? Well, I think what we need to do is have essentially a paradigm shift to a different approach to scenarios, which are answering the right questions. What are you trying to achieve? If you're a business, you're a pension fund, or asset owner, or an asset manager, you are primarily looking at financial risks. And as I mentioned earlier, your legal obligations are to deal with financially material risks. In other words, inbound risk from the environment to your business and not your impact on society or the planet. That latter is, for the moment, as I say, still voluntary and is potentially going to get you into other kinds of problems as we've been seeing over the last couple of years. So we need to have a new set of scenarios which are based on more relevant scenarios on a more relevant time horizon, bringing in the requisite volatility and bringing in the manifold interacting risks of geopolitics, policy, the state of the economy, the financial markets, technology and society. All of those things need to be thought through thoroughly. And this is going to require new methods and modeling approaches which don't rely on equilibrium modeling, which is what we've seen so far from the NGFS. Next slide, please. So I think it's worth just spending a little bit of time thinking about the contrast between the NGFS type of scenario, which is basically looking at long-term systemic impact, looking at the global impact of global warming, and the kind of scenarios that actually businesses and indeed pension funds and asset owners need, which are focused on their own idiosyncratic risks and also their financial risks, the outside-in risks, if you will, the climate-related financial risks. This is not really driven by global warming in the short run, as we'll see in a moment. Okay, next slide, please. Now, the Climate Financial Risk Forum, the CFRF in the UK, did a survey of financial institutions of all kinds recently, asking them what kind of use cases they had for climate scenarios. And you see there's quite a big laundry list here. Interestingly, most of the use cases are to do with financially material questions rather than impact or net zero planning, if you like. So the ones with the little planet symbols on that I've added to this graphic are the ones which have some kind of impact dimension. And the other thing that's noticeable about most of these use cases is that the decisions involved typically involve time horizons of 5 years or indeed a good deal less than that. So we do need to revisit the time horizon, because this has a material impact on the kind of scenarios we need to be looking at. Next slide, please. And the key point here is that whilst there's huge uncertainty about what's going to happen to global warming through the rest of the century, this is this fan chart here, there isn't a lot of uncertainty about what's happening over the next 5 to 10 years. You'll notice on this graphic that the lines are basically pretty close together until we get into the mid-2030s. In other words, global warming is pretty much baked in over that time horizon, as is an increase in extreme weather. We are going to see increasing acute physical risks manifesting themselves around the world. So we have to take that as a given. From a scenario perspective, this isn't uncertain. The uncertainty lies much further ahead. The other point here is, of course, most of us have signed up to net zero. We realize we have an existential problem in the long term. And therefore, what we really should be focusing on is how to deliver net zero and looking at the different ways in which net zero could happen. So we're much more interested in fact, in transition risk rather than physical risk, which, as I say, we should regard as pretty much a certainty over the next 4 or 5 years. Okay, next slide, please. The good news is that there was, rather quietly, a conversion by the NGFS last year. They announced in a note, a so-called conceptual note, that they're going to focus on short-term climate scenarios. They really conceded a lot of the points that I've been making here, which is that different drivers are involved. They conceded that chronic physical risk is indeed a predetermined, and smooth pathways are going to be replaced by volatility and non-linearities, and financial market expectations will be a driver and not a consequence of the scenario. So I think we should be looking for quite a change in the kind of scenarios we're going to be getting out of the NGFS over the next 2 or 3 years. So next slide, please. So this gives you an indication of what we did with USS last year, and Mirko will talk about this as well in a moment. But essentially, we decided to start from scratch, looking at the transition risks, looking at what's a likely path for policy, and not just looking at some kind of abstract assumption about carbon pricing. Look at what's going to happen to the state of the economy, because it is a driver of emissions. We're not on a smooth pathway in terms of economic activity, as we've seen over the last 5 years. There are social influences, and there's all sorts of uncertainties about technology. So we recruited a network of experts on these topics, and plus we brought in finance as very much a driver of these scenarios, as well as a consequence of the scenario. So this is the process that we went through. Next slide, please. And we put together this matrix, which gives you 4 different scenarios where the 2 driving dimensions of the scenarios are, on the one hand, on the vertical dimension, policy, what's happening to politics and policy. Is it moving quickly towards net zero and decarbonisation, or slowly? And then on the horizontal dimension is what we call market dynamism, which reflects the growth in the economy, the progress of technology, societal pressures, and so on. If you like, the private dimension of the transition. Where we want to be is in the top right-hand corner, what we call the roaring 20s. And this is where markets and policy align. Where we fear we might be, and obviously after the events of the last couple of months on the political front, mentioning no names, we could be in a situation where policy is actually moving slowly, or possibly in some respects in reverse, and the markets may also struggle to deliver on net zero as well. And then there's a couple of intermediate combinations that you can see in the matrix. So this is the set of narratives that we put together, and we are now in the process of trying to quantify these. Next slide, please. And just to conclude, I think it's worth reflecting, and this goes back to the question about whether or not pursuing impact goals is a win-win from a point of view of profitability. If you think about it, your success in delivering on your impact goals is very much dependent on the behavior of others. This is the classic collective action problem that economists talk about. So what you do is also going to be affected by what others are doing. So what this matrix does here is to identify the distinction between systemic success, which is the green row at the top here, and systemic failure, which is the red row at the bottom. So this is where the world is going green, and this is where the world is staying red. The columns show what you're doing as an individual organization. If you're failing, that's this left-hand column indicated by these red dots. And if you're succeeding, you are in the right-hand column indicated by the green dots. Now, where we want to be, of course, is everybody's going green, you're going green, and ironically, you don't have to worry too much about engaging with people because everybody's doing the right thing. You can, in effect, free ride. What people, of course, are worried about is that they're not actually going quickly enough. Maybe the world is going green and you're being left behind, and you may be hit by stranded assets, what I call fossil stranding here. But, and this is something which hasn't received enough attention in my view, there is such a thing as premature virtue, which is where you go green, but unfortunately, the system isn't. And if you think about it, going back to what Kerry said at the outset, we are at the moment not making good progress towards the halving in emissions, which many people reckon we need to achieve by the end of this decade. And therefore, some of your green investments are in danger of underperforming, at least in the short run. So in my view, there is a trade-off, certainly in the short run, and perhaps even in the long run, depending on what happens in the system. So I think this distinction between systemic and idiosyncratic scenarios is absolutely central, I think, to our understanding of how we should be using scenarios in the future. Okay, so just to conclude, next slide, please.
We're gonna have to wrap up because I know that Wilhelmina's got to leave soon. So just 1 minute. Yeah.
Okay, no, that's absolutely fine. I think essentially the point here is we have in this report, which we published jointly with Mirko and his colleagues at USS, had a go at producing some of these new narratives in the No Time to Lose report. If you haven't seen it, please take a look at that. We've attempted to bring in the kind of volatility and financial considerations, which I think are required to produce decision useful scenarios.
Yeah.
Thank you very much.
Thank you, Mark. And I'm going to go straight to Wilhelmina, and if Olivia, you could bring our panelists up, because I know that Wilhelmina has to leave very shortly, imminently. So I'm going to go straight to Wilhelmina, if she's still there. Yes, she is. Can we put this into the European pension context? And for those, please save your questions for Mark at the end, and we have a whole big Q&A session. Wilhelmina, just putting this into a European pension context, while the EU has gone further than any other jurisdiction really in recognising the need to address double materiality in reporting requirements, does this go as far as the scenario process as well? Are scenarios essentially being used to assess the financial material risks of climate change onto the organisation only?
Thank you so much. And I'm terribly sorry that I am a little pressed for time today, but anybody that would like to follow up in more detail by email or LinkedIn, I'd be more than happy to. Regarding what you mentioned in the EU context, well, we saw the poll results, and actually, I think what I know from my experiences working with many pension funds and other asset owners throughout Europe is that this problem is being looked at extremely seriously. So there is, I think, a very high level of sophistication. However, as you said in your introduction, it is a really complex topic. And regretfully, I think there is still sometimes a lack of actual implementation action on the back of what the scenarios are saying. There are a few very notable exceptions. I think some, especially Western European pension funds, have gone quite far in divesting from fossil fuels altogether. So, those are some very well documented cases. However, I think many others still struggle kind of marrying the two ideas of portfolio resilience and net zero, and wondering if net zero is really the best way to also manage your climate systemic risks, and is there a bigger picture? I think there's a little bit of an axis between kind of impact and net zero and portfolio resilience, and I think you'll find different institutions kind of having different views on exactly how fast they should be moving, and sometimes making that pace of decarbonization sometimes a bit contingent on how fast the rest of the market is moving. So that collective action problem. I think there's a lot of attention also for physical risks, physical hazards. How does that, because net zero is not in any way going to necessarily protect you directly from extreme physical risks. So I think that is much more top of mind. Very top of mind is kind of progressing away from damage functions, which are quite broad and not very specific, to looking much more at near-term hazards, because that is often more near-term and within the investment horizon. But I think also many European investors keep pushing the boundaries around climate scenario analysis. And I have to say that's why it's also such an amazing opportunity that Trek spun out of the University of Exeter recently and is actually commercializing, quantifying and commercializing the scenarios that were just presented. So we're very new, so we're very interested how that we picked up also in the European markets.
That's great, Marina, and more information can be sent about that afterwards as well.
Thank you.
Is there anything else you wanted to say before you leave?
No, just thank you very much. An amazing panel, and looking forward to connecting with people as follow-ups. Have a great rest of the time.
Thank you.
Thank you for having me.
Thank you. Mirka, I'm going to turn to you. We've heard Mark set out really comprehensively the challenges that we have at the moment. As from the perspective of the largest UK pension scheme, USS, why did you overhaul your scenario approach? What were the key components that you needed to be different? And you're on mute. Always one. Maybe while you sort that out, I'm going to go to Simon. Simon, carbon trackers loading the dice, which many would say has been the catalyst for a lot of this. You really put the spotlight on the flaws of using integrated assessment models, as Mark mentioned, and the prediction, the damage calculation predictions, leading to that huge disconnect between what the scientists are predicting the impacts of climate change will be and what pension schemes are currently factoring in as part of their investment allocation process. Can you tell us a little bit more of the key findings of this report?
Yeah, sure. Hopefully you can hear me all right.
Yeah.
Okay, so let's just slice this into a little bit of context. Loading the dice has been, and you very kindly said the catalyst, but loading the dice is part of a series of work that's been done, including our friends at USS and including the IFOA and including, of course, the University of Exeter and our friend Mark, who's on the call today. So, but loading the dice focused on a particular area of the IAMs, which was the damage equation. And it's the damage equation that is sort of tucked into the very foundation that a lot of people don't really often have a look at. And it essentially converts your scenario into GDP damage. That's what it does. It converts your scenario into, in many respects, US dollars. So a couple of key points. The first thing is that the model assumes that GDP is fungible. In other words, it implies that the 4% of global GDP, which is the entire world's food agricultural system, can be replaced by producing more stuff. And putting it in another way, it does not recognize, the model does not recognize that dead people don't update their iPhone or Windows software, which is quite shocking. The second, I think, key point is that the model assumes the effect of temperature change is linear. Or in other words, again, putting it into everyday context, it doesn't recognize the difference of turning your fridge ice box up 1 degree from -1 or -3 to -2 is different from turning it up from 0 degrees to +1. And we all know what happens to your ice when that particular tipping point is breached. And so as a result, what your damage equations are doing is they're underestimating the size of the damage, which is essentially, you could put it in the cost of doing nothing, which by default makes the cost of doing something relatively more expensive. It also overestimates the time in which we have to fix it. And that further reduces the cost of doing nothing through the discounting mechanism, which means that the advice that is going to asset owners is that a 3-degree world is best for your portfolio. And it also allows users to think that you can use modern portfolio theory to diversify away climate risk. And in many respects, our report also goes some way to dispel the tragedy of horizons, this idea that everything happens into the future. And we have some wonderful slides which we can share with people to show that mechanism. Furthermore, it shows that what we call climate denial is unwittingly ingrained in everything from government policy or central bank stress testing to those who are looking after your pension savings and future dreams or hopes, if you like. But also, and lastly, very lastly, it alludes to the point, not heavily made in the report, that tipping points are not just physical. And a good example of this would be the insurance. If you can't insure something, you can't finance it. If you can't finance it, you can't grow it. We've heard quite a lot about how insurance companies are pulling out of areas, for example, the seafront of Florida or whatever. Yet people are still flocking there. And this is because as long as the state bails them out, who cares about having insurance? However, and here's a quick unfun fact for you all, and I will stop after this, is that insurance claims losses this year hit $10.6 billion US dollars, just shy of the 11.3 billion US dollar in the premiums that the insurance industry received from the fossil fuel industry. And that means, and here's the tipping point, is that providing insurance for the fossil fuel industry is about to become a loss-making occupation for the insurance business. Now that is a tipping point. Anyway, back to you, Kerry.
Fantastic, Simon. And yes, that's a very tangible, follow the money kind of evidence example there. Mirko, I do think we have overcome the technical challenges. So back to you. So really what I wanted to understand is why you felt you needed to change overhaul your approach to climate scenarios.
Very good, and good afternoon, everyone, and apology for technical problems. Okay, so back in 2022, we carried out our first climate scenario assessment. We used at the time a rather more conventional approach. Actually, we partnered up with Orton Finance, that you really knows very well. And basically, we spent quite a lot of time. We had discussions with the board, with all of our non-executive bodies about the findings. So actually, the most useful part of that analysis is the actual discussion of the shortcomings. So in essence, we identify a number of shortcomings. First of all, the focus on very long-term investment horizons. Mark has already spoken about that. This really compounds the uncertainty and makes it very, very difficult to really understand how a complex interplay between climate and all other factors driving macro and financial markets value could evolve over such long time frames. So we found that to be unhelpful. We found that the physical risk modeling was in the end using very simplifying assumptions. Ultimately, if you dig deeper, there is an assumption of a relationship between temperature and GDP, which is a very rough proxy of what the impact of physical risk might be. And the transition dynamic, especially because you have to try to model it over such a long time frame, is very, very simplified, very stylized. So it's very hard to derive any implications that are more granular for a specific sector and specific countries. So in the end, we ended up with an estimate of a 70 basis point difference between the best and the worst case scenario for climate. And we pondered on that and thought, well, there isn't very much you can do with that information. It is not really decision useful. You can't really make investment decisions with that information. So in essence, that really helped us sort of understand what were the key priorities. We're looking for a new approach, and essentially shorten the time horizon, integrate physical risk explicitly, so integrate the perspective of the climate scientists, and model the transition in the context of the wider sort of macro geopolitical context. So this really was our objectives when we partnered up with the University of Exeter in the No Time to Lose report.
Thank you. And Mirko, on that, how did that the new approach, the narrative approach you mentioned, how does that practically work? What were the governance and other changes that you had to make to support this new approach?
Yeah, so this is a more difficult approach. So it does require important. It does require very supportive stakeholders to begin with. We were very fortunate at USS because, well, first there is an extensive delegation model. When it comes to implementing this type of approach, this is much harder than a traditional strategic asset allocation exercise, and a greater delegation makes it easier. So if you can delegate to a team of investment professional some of the key decisions rather than having to go through multiple boards and stakeholders, it is easier. So we're very fortunate that we have such delegation in place. We have an in-house fiduciary manager. There is an extensive delegation from the trustees to the fiduciary manager. But also, you need to rethink how you assess risk and performance. If you assess performance purely on the basis of outperforming a benchmark, and you look at risk purely on the basis of the backward-looking volatility and tracking error, it becomes very difficult to use a very innovative approach like this one. And we have, again, moved away in our governance framework for a pure outperformance target and risk management based on benchmarks, and using a balanced scorecard concept where, for example, the management of physical and transition risk is explicitly one of the criteria that the investment committee and the board look at when assessing the performance of the fiduciary manager. So these are some of the governance changes. But in essence, how it works, it is a process that requires multiple steps. Narrative scenarios is really the first step. You try to outline how the interplay between the transition and other driving factors of the economy and financial markets is going to play out in alternative states of the world. These are very rich. Look at current events and try to understand how all these factors could develop over time. So we then there is then an exercise to take these narratives and assess the implications for macro and financial market variable. And you really start the quantification with some assumptions, and rather than putting straight a narrative into a model, you start thinking about assumptions and quantify plausible ranges for key variables. And this is already with quantified ranges for key variables, you can derive investment implications. So we then develop an investment outlook based on our assessment of the implications of key variables, and derive some investment implication from the outlook, which then have been incorporated into a strategic asset allocation process, essentially, and led to some portfolio changes. That's in essence the flow. It requires delegation, it requires flexibility. Sometimes some of the changes are beyond the traditional boundaries of asset classes, so you need to look at not just asset allocation but also mandate design. So that also requires some flexibility in how you interpret and how you translate some of the results into practice. I'll stop here, but you can go into more detail on some of the changes we made.
Yeah, please do. And then just before that, though, Mark, your experience with other pension schemes, are they addressing these current scenario challenges in a similar way that USS are doing that?
I think some of them are beginning to address it this way. I think, as Willemijn said earlier on, I think we were at the phase where people have acknowledged the problem, but I think they're still trying to figure out precisely how to act upon it. So my sense is that that USS is really in a pioneering position to a large extent in terms of having gone through the process of producing bespoke scenarios with relevant time horizons and variables. But of course, it is, as Mirko mentioned, challenging to put numbers on these things. But I think it's very important for people to get away from the idea that models are going to save you from this problem, that it's much more a case of getting broad orders of magnitude or even the right direction. And I'll give you one illustration of this. The NGFS scenarios all assume that carbon prices and fossil fuel prices will rise continuously in the future. All of the scenarios have that happening. Whereas it's patently obvious that we could easily see a collapse in fossil fuel prices, possibly quite soon, actually, if you think about what President Trump is now talking about doing, and possibly with the support of the Saudis, we could see another collapse in fossil fuel prices. That is nowhere to be seen in the official scenarios. And therefore, a lot of the time, it's about having a sense of direction, let alone getting into the decimal points and the basis point. But of course, at the end of the day, you have to allocate capital. You have to make quantifiable decisions. But I think we shouldn't kid ourselves that we're doing anything other than employing expert judgment here, because yes, models can be helpful on occasion, but you can't just bank on the models to give you the answer. The answer is typically inside your own head.
And on that, the expert judgment, Simon, with your engagement with the investor consultant and asset management community on this, in particular the advisors, how are you seeing that they're addressing these issues that are coming up, and how are they working around it in the expert advice that they give to the pensions?
Yeah. Okay. So, I mean, look, let's set a little bit of context here. A recent survey of about 300 plus asset owners revealed that physical climate risks are at the top of their biggest concern, with about 89% respondents claiming to have conducted extremely or moderately robust assessments and modelling of this risk. And I think that's reflected in the poll that we had earlier. The same survey, however, said that most asset owners are focusing on disclosure rather than asking for explicit company action. And I think this is backed up by our own ongoing FOI freedom of information inquiries with the UK local government pension funds. How are they working around this? Well, I suspect this is probably a great question for Mirko. But in our experience, with extreme difficulty, and Mirko is in a very lucky position of being an asset owner and asset manager all rolled into one, with such compliant beneficiaries and experts on the various boards, and that you should be taken into account. And I suspect, even from what he's just said, that they're finding it very difficult. But if you're a more or not so lucky asset owner, why is it so difficult? Well, practically, if the advice you're being given by your advisory services, the so-called experts, and the advice is saying that a 3-degree world is best for your portfolio, then who are you? And how do you go onto your beneficiaries and say, we actually think this is rubbish? And the reality of the matter is, just like everybody else, the investment consultant community is struggling to come up with the same, in many respects, is struggling with the same questions that we're all talking about. And crucially and interestingly, the problem is not confined to asset owners. a similar situation is happening in the asset managers level, who run their portfolios through models such as the MSCI Climate VaR, value at risk models. And this is kind of, if you like to put it in the sense, a climate beta of a fund. That's what they're trying to look at. A well-known asset manager had one of its funds put through the VaR, and it said that its fund was best at a 3-degree hothouse. And it's not until you then dig into the disclaimer that sits in there, and I will quote from the disclaimer: "This report may not fully reflect the future economic reality, should not be construed to represent any belief regarding material or financial impact, and is provided for the purposes of complying with applicable ESG reporting requirements or policies." So it's effectively a tick box exercise. And that in itself is quite shocking. So that's why practically on the ground, a lot of people are struggling.
Yeah. And on that point, I think I'm very conscious of the fact that we've talked a lot about the problems, and we want to kind of make this as practical as possible, and what some of those kind of key takeaways. Mirko, you have really described how you have taken that, but you've also recognised you're fully resourced asset manager, asset owner, and your members are very much supportive and very vocal on systemic risks and addressing that. There is a lot to get your head around, Mirko. What would you say are some of the kind of key takeaways that you would give the audience today, whether maybe talking to your audience of asset manager stroke asset owner?
Well,
to Simon and Mark.
I think it's complex. It requires a change in mindset. It requires engagement from the key stakeholders. And I think it requires rethinking the role, rethinking the entire asset allocation process. It is not just about running climate scenario analysis as a tick box exercise or to comply with TCFD regulation. It is rethinking the asset allocation process. And actually beyond that, I think what we're actually aiming to achieve, and we haven't achieved that yet, is to develop a process that is consistent in terms of how you look at the climate transition from a bottom-up perspective, and you then integrate it into asset allocation decision, and how you look at it when you assess individual investments, being an asset that we might consider for a private markets program, or our stake in a listed company. So ultimately, aspiring to have an integrated framework, top-down, bottom-up, which is actually not available. Any of the solutions off the shelf would not be able to give you that. So we think it requires investment on our side to actually build something that can really satisfy that.
Thank you. And Mark, same question. Yeah,
I mean, I very much agree with what Mirko has just said. I think a couple of things that might be worth mentioning at this point, though, which is to say that there are certain key conclusions that have already come out of the work that we've already done in terms of rethinking shorter term narratives. So first of all, not everything is uncertain. There are certain things which we can be very confident of. And sadly, just to reiterate, we can be very confident that the planet is warming for the next 5 to 10 years. Whatever we do, it's baked in. You have to be thinking about this. Now, the investment implication of that is very clear, which is that there is an unmet need for adaptation. We are working on mitigation, but I think it's very clear that solutions that address adaptation are going to be needed. Now, of course, that is partly predicated on public policy action, so if it's flood defenses or storm protection or whatever it might be, but that is a need that will be coming through regardless. I think it's also very important to recognize that at the moment, sadly, the risks on the physical side are being underplayed, and the chances of us actually meeting the Paris goals are low in the short run. And that, again, also has a consequence, which is that it does look as if we are falling short in terms of delivering the emissions reductions. So the second key point that people need to be thinking about is, if you are making impact goals, in other words, net zero commitments, you need to be very careful about the interim targets that you're setting. So, for example, I know a lot of asset owners have made commitments of the kind of, we need to do what science is telling is required, as in reducing financed emissions by 40 or 50% by the end of the decade. Now, is that realistic? You need to reflect on that, because that could be overambitious. After all, we're not doing very well collectively on that. And so if your investment strategy is betting the ranch on that outcome, you need to be preparing yourself for the potential for losses. Will your stakeholders be prepared to bear those losses? So you've got to be communicating extremely clearly to your stakeholders about what you're actually doing and what you're actually assuming and why, which is, again, why it's very important to have very clear and specific scenario narratives. You know, there's no point in having a blizzard of numbers. You actually have to have a sort of clear story. Now, where is the good news? Well, the good news is, as I mentioned earlier, that whilst physical risks seem to be fat-tailed on the downside, technology risks seem to be fat-tailed on the upside. We thankfully are making good progress on a lot of renewable technologies. I know a lot of asset owners are very much on top of that. They are investing in those things already. But I think those are the kind of things that you should be placing particular emphasis on and looking for the opportunities as well as managing the risks.
Thank you, Mark. And Simon, I'm going to ask you to have a couple of quick comments, and then we're going to open the floor to questions. Emil, I'm going to start with you. You've just posted your question. Okay, so Simon.
Yeah, a couple of quick ones. I mean, firstly, you know, I like to try and visualize what climate change is in my mind. And I see climate change and what the models are doing as like a person that's just thrown themselves or jumped off a 124th floor building. And the models are checking each floor that he's passing and going, oh, everything's okay. And then it's forgetting the fact that there is an end point where everything just falls to pieces. And I think that's how I see the current situation. And if you get that into your mind, is a very good practical first start, I think. The second thing, and that comes to the presentation of the information that you're getting. You're obviously often presented the impacts of your GDP on a yearly basis. What you're not, and they're averaged out. What it's not saying, and there's a difference between an average each year of 3% and the first 10 years being 0.001%, and the last year being a total obliteration of your portfolio. And so, you know, that's the first thing to do, is visualize and context yourself in that. Second thing is to deploy the sniff test. If it doesn't seem right, and as what Mark has alluded to, the scientists are saying something's not right. So if your experts are coming back and saying the best thing for your portfolio is 3 degrees, then you've got to throw the question back straight at them and ask them to move away from a global GDP top-down approach and ask them to get their investment managers to stress test the model they have on your individual holdings, you know, your apples and your whatever, in a 3 degree world where potentially London is underwater, food is in short supply. I mean, yesterday, DEFRA published their 2024 UK food security report, which warned that climate change poses a pressing risk to UK food security. So if you think there's going to be that, don't worry, food's going to be fine, you're wrong. And that's going to cause mass migration. And let's see what your portfolio's worth then from a bottom-up traditional financial analysis, and say, well, okay, based on that, does that suit my maximum acceptable drawdown? Then, you know, happy days, you're away and free. But these are practical things that you can do right now within the constraints of the scenarios before you can even worry. You have to try and worry about changing the way people are thinking. Anyway, that's my 5 piece worth. Hope it was helpful.
Very much so, and I think that leads us into Emil's first question.